Hey guys, it's David here. In this recording, I'm going to be reviewing all the trade ideas for the May expiry. In the month of May, there were a total of 4 trade ideas for the May expiry. And those trades were in DIA, Diamonds ETF, XLV, another ETF that tracks utilities, GLD, an ETF that tracks the price of gold, and ZM, which is Zoom. But before I dive into the 4 trades, let me mention my portfolio size that I'm using for vertical spreads. When we launched the vs.com project, I created a new Tasty account solely for the purpose of trading my forum trade ideas. This account is separate from my personal trading account and it's totally segregated. I was working on the assumption that the median account size of our members would be around $5,000. And I funded this VS vertical spread segregated account with $5,000 and I size all my trades according to the guidelines I laid out in the Option Strategy 101. So for the $5 wide spread, I trade 2 contracts, and that equates to a maximum risk of $1,000 less whatever premium I received for the trade. This position size ensures that I can take up to 5 trade ideas in my VS Trade account. I opened the VS Trading account on the 1st of April, and that was just a few weeks before our beta members joined. And there were some trades I took in the account before the beta members joined VS. Now, that initial account size of 5,000 has now grown to 6,232 since the 1st of May. So the initial account size was was 5,000. As of the 23rd of May, that is now 6,232. And that represents a return of about 24%, which is a bit more than you'd get from your bank savings account. And if I was to benchmark that performance against the market's broad index S&P 500 over the same period, that performance outperformed the benchmark. So a bit of context for you about the performance to date. As for the 4 positions in the May expiry, here is the profit and loss on those positions. In DIA, I made a profit of $192. In XLV, I made a profit of $150. In GLD, I made a profit of $110. And in ZM, I made a loss of $132. That works out a net profit for the May expiry of $322 on 2 contract position size. And if I was trading 10 contracts, that would have been a profit of $1,600. Now let me show you my Tasty P&L account. So this is Tasty. Year to date, I had a trade in Alibaba before the beta members joined. 2 contracts, I made a profit of 174. The diamonds, you can see the 192 there corresponds to that 192. Disney, I had a position which I had to scrap because it wasn't working. And even though it wasn't working, I still managed to scrape a profit of $44. GLD showing a profit of $230. I had a trade before the beta members joined. So in the month of May, my P&L on GLD was 110. So that is incorporated into that larger P&L of 230. IWM, I've got an open position in IWM. That's why I've got some unrealized profit. This is realized profit year to date. And ZM, Okay, I had a position in QQQ before the beta members joined. I made a profit of $188. I also had a position in Spiders, SPY, made a profit of 210. And XLV, this one here, I made a profit of 150. ZM, as you well know, it haunted me for a while. I made a loss of 132, so that's the only losing position since I opened this account. The total profit, as you can see here, is 1,232, and that gives me a return of 24% since April, like I said. So now I've gone through the numbers, let me dive into the individual trade ideas and positions and talk about how they hit my radar, how I chose the strikes, how I structured the trade, how I managed the trade if there was need for it to be managed, and how I closed the trade. So I'm going to go through them one by one. So I'm in the main forum now. I'm going to go to the Trade Ideas forum. And for the month of May expiry, I'm going to go to the DIA trade. So this trade was opened on the 1st of April. The underlier is DIA, which is Diamonds, an ETF that tracks the Dow Industrial Average. At the time, the price of DIA was $209.13. Implied volatility rank was 67.4%. And this right here is the main reason, the main underlying reason why I took on this trade. It had nothing to do with my directional bias. I was neither bullish nor bearish. I didn't look at the charts to find out if it was approaching resistance or support, or if there were head and shoulders or a double bottom. But the main reason why I put on this trade was because the implied volatility rank was high. It was at 67.4%. There were 44 days until the May options expired when I put on the trade, and that falls within my criteria for time to expiry. I normally put on my trades between 30 to 45 days until expiry. That's when the theta decay is at the theta is at the highest, and from 30 days downwards the theta decay accelerates, and I don't want to be selling there because most of the theta decay would have happened. The trade I put on was selling the 192.187 put spread, and for selling that spread I received a credit of $1.46. Once I put on the trade, I put my order on the market and I got filled for 146. I then created what I call a GTC order. Now, there are many traders who trade credit spreads and they put on the trade and wait either until the expiry week before they start thinking of closing the position, or they really haven't got an idea of where they're going to get out, or they want to hold it until the option expires so they can keep the entire credit of $1.46. But I tend not to be too greedy, if that's the right phrase for it. I like to close the position when the easy money has been made, if you like. I don't want to hold on for the final 30, 40, 50 cents, which would mean more profits, but it would mean more stress, and it would also mean I would have to spend a lot more time in front of my computer screen close to expiry trying to get out of the position and buy back the spread. So what I tend to do is once I put on the trade, once I put on the order and my order gets filled, I create what I call a profit target order, and that's a GTC order, a good until cancelled order, to buy back the spread that I just sold and to buy it back at a lower price. In this case, I sold the spread for $1.46. and I put in an order to buy it back for 50 cents. Well, on the 9th of April, which was 8 days after the position was opened, remember it was opened on the 1st of April. On the 9th of April, my GTC order, the profit target order that I put in to buy back the spread for 50 cents was failed. It got failed and the position closed. At the time the position closed, DIA was at 237.57. When I opened it, it was at 209. And implied volatility had dropped to 46. It was in the 60s when I sold it. Yeah, implied volatility was at 67 when I sold it. It had dropped to 46, and that resulted in a profit of 96 cents or $96 per contract. And because I was trading 2 contracts, that resulted in a profit of $192. So that's the review of the first position, which was a trade idea in DIA. I'm now going to move on to the second one, which is the trade idea in XLV. So I'm going to go back to the May expiry again and then go into XLV. Right, so XLV is an underlier that it's an ETF that tracks the utility sector. And this position was opened on the 3rd of April. XLV, just a quick note on the date format here. For my fellow members who live in Europe, London, or, the date format is the American date format. So it's the month first and then the day. So this is April 1st. This is 3rd of April and not the 4th of March. Okay, so XLV was trading at $86.57. Implied volatility was at 51.4. There were 42 days until the May expiry when I put on this trade. So to check off a few things, the implied volatility rank was over 50%, check on my criteria list. Earnings, well, XLV is an ETF. ETFs do not have earnings, check. Days to expiry, 30 to 45 days. This was 42 days, check. So this meets all the criteria. The trade I structured was selling the 81.76 put spread. I sold the 81 strike and I bought the 76 strike, and I received a credit of $1.15 for selling the spread. Once I opened the position, I put in a GTC order to buy back the spread for 40 cents. Excuse me. Put in a GTC order to buy back the spread. I sold for $1.15 for 40 cents. And on the 9th of April, 6 days after the order was placed or after the position was opened, my profit target got failed and the position was closed. I bought back the spread for 40 cents. My profit on this was $75 per contract. I sold 2 contracts and that was a profit of $150. So that was how that position panned out. The third position is in GLD, which is a gold ETF. I'm going to go back to the main forum again. May expiry, GLD. GLD is another ETF, so there were no earnings announcements due over the duration of the spread. Implied volatility was a 59.9, greater than 50, check. There were 39 days to the May expiry when I put on this position. That falls within a 35 to 45 day window, another check. I sold the 166, 172 call. And at the time, GLD was at 156.91. So my short strike is $10 away from where the market was when I opened the position. So GLD was at 156.91. I sold someone the right to buy GLD from me at $166 over the next 39 days. And for that, I received a credit of $1.05 there. Once my order was filled, I created a profits target order, which was a good until cancelled, to buy back the spread for 50 cents. And at the end of the first week, the other two positions I didn't get to do a review at the end of the first week because the position closed at the end of the first week. In this case, the position didn't close at the end of the first week. So the end of the first week for GLD was on the 17th of April. GLD was trading at 158.57. Remember, I sold it at 156.91, and this is a good trade to highlight theta decay and one dimension of how it works. So I sold the 166 call, giving someone the right to buy from me at 166. As GLD goes from 156 towards 166, this premium that I received, say I received $1.05, all things being equal, should be going up. I should be losing money. However, look at what happened here. So remember this, GLD was a 156.91. At the end of week one, GLD was higher. It was a 158.57, and yet I was showing a profit of 45. And that is theta decay for you. And I'll explain how that works. If the day after I sold GLD was at 158, I would be showing a loss. But given that there were 39 days to go, and after 11 days, GLD only moved up $2. The way the algorithm works, the theta decay was greater than the delta movement, if that makes any sense. So even though the market moved up, it took so long for the market to move up by only $2 that the algorithm thinks it's unlikely the market would get to 166 in the short time left on the trade. I hope that makes sense. So on the 17th of April, GLD was at 158.57, which is higher than what we sold it for, but 11 days had passed since I sold the spread. And if it's going to take 11 days for the market to move $2, then it's got a long way to get to 166. So the market makers marked down my spread. And my short strike had not been tested, clearly not. It's a 158. My short strike is a 166. So there was no need for me to make any adjustment to this position as of the 17th of April at the end of the first week. Well, on the 30th of April, my profit target order was hit, and I got filled at 50 cents and the position closed. At the close, GLD was trading at 157.8, which is not very far off where it was when I opened it. I opened it at 156.91. I saw the 166 strike, and with a few days until expiry, the market makers marked down the spread significantly. Significantly enough for me to be able to close this thing at a profit. So I was in the trade for 24 days. IVR was implied volatility was at 56.2 when I closed the position. And this resulted in a P&L of $55 per contract. I sold 2 contracts, and that was a profit of 110. Now moving on to the final position, which was in ZM. And this is a bit of a long one. So ZM was opened on the 13th of April. I've actually got the day in the European format on this one. So the trade was opened on the 13th of April. At the time, ZM was at 135.79. Implied volatility rank was 66.4. And there were 32 days until the May options expired. So IV rank was high. There were no earnings during this window. And there were 32 days until the May options expired. So that is well within my days to expiry criteria of 30 to 45. I sold the 160-165 call spread, and I received $1.10 for selling the spread. I created a good until cancelled order, a profit target order, to buy back the spread at 50 cents. Now the weekly update. At the end of week 1, on the 17th of April, ZM was trading at $150.06, which is significantly higher from where it was when I sold it. Remember, it was at 135.79 when I opened the position. So at the end of week 1, I was showing a loss, a negative P&L of $210. I still believe that figure is slightly wrong. It's too high for the movement. My short strike is 160, so still $10 away. But this stock is so volatile, the market makers move the spread aggressively. I saw the 160 strikes. So with the market at 150, my short strike is still $10 out of the money. So my short strike at this stage had not been tested, and there was no need for me to think of making any adjustment to the position just yet. On the 24th of April, ZM was now trading at 162.8. Remember, I sold the 160 strike, which means my short strike has been tested and it's now in the money, and it was time to do something with this position. So I sold the 160 strike, and with the market at 162.8, I sold the rights to someone. Well, I gave by selling a call option, I was giving someone the right to sell ZM to me at 160. Take that back. By selling a 160 call strike, I gave someone the option to buy ZM from me at 160. Well, ZM is now at 162. So if ZM expired on this day, on the 24th of April, that person would definitely exercise the right to buy from me at 160, and they will sell it in the market for $162.80 for an instant profit of $2.80 per share. So my short strike was tested, and I decided to adjust the position by selling a put spread and converting my call spread into an iron condor. The put spread I sold was the 150, 145, 145 put was what I sold. And I sold it for a credit of $1.80. I sold that. I sold it for $1.80. And recall I received $1.10 for the call spread, which is still open. So even though my strike was tested, I didn't close it. I simply sold another spread underneath it. And for this spread, I received $1.80. And that brings my total credit received to $2.90. The position I now had on is an iron condor. So I sold the 160, 165 call spread, and I sold the 150, 145 put spread. And I put in my GTC order to buy back the iron condor at $1. And what's missing here is some emotional roller coaster I went through with this position. And I think I covered it already in one of the journals. The problem I had with this position was this is the first expiry since the beta members joined, and I had arbitrarily set a target to have 4 profitable trades. That is not something I would normally do in my personal trading. But in this case, my emotions got the better of me. So I had ample opportunities to close this position at break even or even a tiny profit. But my logical thinking didn't kick in. I was thinking about having 4 winning trades in the first month of verticalspread.com. But I learned my lesson. So I took the trade all the way to the expiry week, and I think I closed it a day before the expiry Friday. I closed it on a Thursday. I ended up buying back the spread for $3.56. And remember, I collected a total of $2.90 for it. So I was buying it back for a higher price than I sold it for. And that resulted in a loss of $66 per contract, which equates to $132 for the 2 contracts I sold. So that resulted in a loss of $132. So those are all the 4 trade ideas I had in the May expiry. The net profit was $320 on the 2 contracts position size I was trading. And if I had traded 10 contracts, that would have been a profit of $1,600. If you have any questions about any of the trade ideas, you know what to do. Hit the reply button and I shall endeavor to answer your questions. Thank you and see you later. Goodbye.